Oil should be exploding right now. There is a war on. The US and Iran are fighting. The Strait of Hormuz, one of the most important choke points on Earth for oil, is seeing traffic collapse. And now the Houthis are striking ships in the Red Sea, threatening to cut off millions more barrels a day. By any textbook logic, crude should be ripping higher. So why isn't it? Welcome back to Microfinance. Today we're breaking down one of the strangest disconnects in the oil market in years. A disconnect that has some of the sharpest strategists on Wall Street openly admitting they're confused. Let's set the stage. Since this conflict reignited in late February, the world has lost an enormous amount of oil supply, an estimated 11.1 million barrels a day, or roughly 1/10 of total global demand. According to a team of JPMorgan strategists led by Natasha Kaneva, that loss has already pulled global inventories down to record lows, and it's not over. The Houthis have now started targeting vessels moving through the Red Sea, a critical release valve for oil coming out of the Persian Gulf that threatens to choke off another 5 million barrels a day, this time out of Saudi Arabia specifically. So here's the puzzle. Supply is collapsing. Inventories are at record lows. A war is actively escalating. And yet, oil prices are nowhere near their highs. Brent crude only just crossed $101 a barrel. US WTI just climbed past $92. Both are roughly $20 below where they peaked in April and May. If you only looked at the supply side of this story, that math makes no sense. So what's actually going on? According to JPMorgan, the market has rebalanced, but not the way anyone expected. The adjustment hasn't come from supply recovering. It's come from demand collapsing. Even global oil demand is now falling faster and more steeply than in any of the past 6 years, with a single exception, the pandemic crash of 2020. Outside of a once-in-a-century shutdown, this is the sharpest demand pullback we've seen in a decade. The International Energy Agency just updated its outlook, and the shift is dramatic. The IEA now expects global oil demand to decline by 1 million barrels a day this year. Back in May, they were only forecasting a drop of 420,000 barrels a day. That's more than double in just 2 months. JPMorgan strategists put it bluntly. Their original expectation was that this crisis would fall almost entirely on inventories, with demand continuing to grow. Instead, they said the opposite happened. Here's where it gets strange. This demand destruction is so large it's raising eyebrows, because the global economy actually grew above its potential rate in the first half of the year. Strong growth and a historic demand collapse aren't supposed to happen together. And so where is this lost demand coming from? Theory 1. China. Normally the world's largest crude importer, China has sharply pulled back on imports, and analysts suspect it may be quietly drawing from reserves that are essentially invisible to outside observers. JPMorgan itself admits visibility into global oil inventories is poor even across wealthy, transparent economies, and considerably worse everywhere else. That opacity makes China the prime suspect, but not a confirmed one. Beyond China, real demand shocks are showing up worldwide. Southeast Asian countries have curtailed workweeks. European airlines have cut flights. And the US has released record volumes from its strategic petroleum reserve, softening the blow on the open market. But even adding it all up, strategists say it doesn't fully explain what they're seeing. Even with hindsight, rebuilding the model from scratch, they still wouldn't have assumed demand losses more than twice as large as the worst of the 2008 global financial crisis. So what does this mean going forward? If this demand destruction is temporary, prices could still have a lot of room to move once the supply shock evolves. But if it's the start of a deeper structural slowdown, that's a much bigger story, one that touches inflation, central bank policy, and energy stocks for quarters to come. Either way, the oil market right now isn't being driven by the headlines you'd expect. It's a demand mystery nobody has fully solved, and that mystery is exactly what's keeping prices in check, even as the war keeps getting worse. If you found this breakdown useful, hit subscribe. Microfinance covers stories like this every week, cutting through the noise to show you what's actually moving markets. Drop a comment. Do you think this demand collapse is temporary or something bigger? We'll be back as this story develops.